Hello, my dear friends. Welcome to Hari Seva IBBI Valuation Tracker. My name is Rajesh Wadhwani. I recently passed Land and Building Valuation exam. Today we are starting session 5 of chapter Valuation of Real Estate. In this chapter, we will learn construction and use of valuation table. Now we can tell key valuer formulas. Earlier valuation table was used. Now we are using the calculators. Scientific calculator is also allowed in the examination. So this topic name you can say key valuer formula. This formula is very important. All the three approaches. This formula is useful. And we will learn annuities, year purchase, and sinking fund. However, capitalization and rate of capitalization, and redemption of capital, and reversionary value we will learn directly in income approach chapters. So let us start key valuer formula. First one, simple interest formula. Simple interest formula and compound interest formula we have learned in class 8 and 9. We first let's start simple interest formula. Simple interest is the interest calculated only on the principal amount, not on the interest already earned. So simple interest formula, P is the principal amount, R is the rate of interest, and N is the number of years. So this is simple interest formula. From this formula, you will get simple interest of nth year. In this simple interest, if you will add principal, then we will get gross amount formula. Gross amount after say 5 years, how much interest will be there. So first we will calculate the simple interest of 5 years. Then we will add the principal amount, and total amount will be gross amount formula. A is the total amount, that will be principal plus interest. This formula gives the total interest earned over a fixed period on a principal sum. This is added to the principal to find the gross amount at the end of the period. The principal amount is added on the simple interest at the end of the period. Second is compound interest formula. Compound interest is the interest calculated on both the initial principal and the accumulated interest from previous periods. This formula is uh, total final amount is equal to P is the principal multiply inside bracket is 1 plus R, power of bracket is the N. Here A is the final amount after interest, P is the principal amount, R is compound interest rate per period, N is number of periods. This formula considers the effect of interest compounding over time, where the interest earned in each period is added to the principal for future interest calculation. In compound इंटरेस्ट में जो आप 1 साल में इंटरेस्ट अर्न करते हैं, अगले साल इंटरेस्ट कैलकुलेट करने के लिए उसमें प्रिंसिपल अमाउंट और इंटरेस्ट जोड़ के जो अमाउंट हो जाता है उसके ऊपर नेक्स्ट ईयर का इंटरेस्ट कैलकुलेट किया जाता है। तो इस फार्मूला से आपको डायरेक्ट अमाउंट आ जाता है। यदि इस फार्मूला में हम नंबर ऑफ ईयर्स 5 है और इस फार्मूला का यूज करें और 100 रुपये प्रिंसिपल अमाउंट है, तो डायरेक्ट 50 ईयर में आपके पास कितना पैसा हाथ में आएगा वो आ जाएगा। Now we will understand the difference both in tabular form. Simple interest P into R into N. In this formula, you are getting only interest. However, in compound interest, you are getting interest plus principal amount, interest into principal amount, directly final amount of that nth period. If you want to calculate only compound interest, so CI, compound interest, P, this is a compound interest formula, minus the principal amount. So you will get only the compound interest. Future value, in simple interest, you are adding principal amount plus some simple interest amount. In compound interest, future value you are getting directly P into inside the bracket 1 plus R, and power of bracket is the N. In simple interest, interest is calculated only on the original principal amount. This is important. In simple interest, interest is calculated only on the original principal amount. In compound interest, interest is calculated on the principal and the accumulated interest. This simple interest will grow linearly, and this is grow exponentially. This formula mentions P into 1 plus R and on compound interest basis. If annually compound interest, then this formula is used. In examination, you will get maximum annual compound interest only. For your learning basis, if you want to calculate a half yearly or quarterly or daily compound interest, then we have adjust this formula according below. If you want to calculate half yearly compounding interest, for half yearly compounding interest is the compound twice a year. So this formula become P into 1 rate of interest divided by 2 inside the bracket and power 2n. Rate of interest divided by 2 in this formula you are calculating compound interest 6 months twice a year. The rate of interest divided by 2 and number of years multiplied by 2. If you want to calculate compound interest quarterly, then you divide the rate of interest divided by 4, multiply by 4n. If you want to calculate compound interest daily basis, then rate of interest divided by 365 and uh, time period multiplied by 365. Simple interest and compound interest we can learn also with the timeline. Say our principal amount is 100 rupees. Time period is a 5 year, 5 years. Here 0, 1, 2, 3, 4, 5. Here if principal amount is the 100 rupees and say rate of interest is 10%. Then first year you will get the interest of 10 rupees. Second year you will get the interest of 10 rupees. Third year you will get the interest of 10 rupees. Fourth year you will get the interest of 10 rupees. Fifth year, you will get the interest of 10 rupees. So after 5 years, you will get 100 plus this 5-year interest and 50 rupees. After 5 years, you will get 150 rupees. In compound interest on timeline scale, this is 100 rupees. Same rate of interest. Time period is same, 5 years. So every year, first, second, third, fourth, fifth. With the calculation of compound interest formula, first year you will get the 10 rupees. For next year, you calculate the interest, then you add this 100 rupees. Next year, interest is calculated principal amount and previous year interest earned. Total amount will become 110. Now here you will earn interest of 11 rupees. This 11 rupees added this 110 become a principal amount. Added here, this will become a 120. Third year you will get the interest of 12 rupees with the 10% rate of interest, 10 paisa, and you have to add 121 rupees. This will become a 133 rupees. 133.3 rupees. Fourth year interest will be, I am writing here, fourth year interest will be 13 rupees, 30 paisa, and you have added previous year accumulated sum 13.3. It will become a 144, 146.41, 146. Fifth year interest you will earn 14 rupees 64 paisa, and you will add it 146.4. This amount become a 161 rupees. So you see it. If you are going only with simple interest, you are fixed depositing your amount in bank with the simple interest, you will get the 150 rupees. However, you are putting in fixed deposit and compound interest annually, you will get 161 rupees. This is the difference of 11 rupees of the same 100 rupees note. In examination, all the question come on compound interest. If he ask especially you calculate the simple interest, then you use the simple interest formula. Otherwise, all interest is the compound interest annually. Before going present value formula, first we have to learn time value of money. Time is the money. The time value of money is the idea that money today is more valuable than the same amount in future. because it can earn interest or be invested, allowing it to grow over time. As Benjamin Franklin famously said, time is the money, which emphasizes the opportunity cost of not using money wisely in the present. बेंजामिन फ्रैंकलिन ने कहा था, समय ही पैसा है। ये इस बात को उजागर करता है कि अगर आप आज पैसे का उपयोग नहीं करते तो आप कमाई के अवसरों को खो देते हैं, जिसे अवसर लागत अपॉर्चुनिटी कॉस्ट भी कहा जाता है। If money is kept idle instead of being used or invested, you lose the potential earn more from it. If you are you are having 100 rupees note. If you are not putting in bank, you are putting in locker. 5 years from you will get 161 rupees. However, from locker you will get only 100 rupees. So utilize the money with the time. The money will be grow. Same thing I am explaining in tabular form with 3 examples. Time value money. Time value concept state that money today is worth more than the same amount in the future because it can earn interest or invest it. And its purchasing power today is higher than the future. यदि आपका कोई दोस्त 100 रुपीज आज देता है तो उससे आज 100 रुपीज लीजिए, 5 साल के बाद में 100 रुपीज देता है तो उसका वैल्यू 100 रुपीज 5 साल के बाद में नहीं रहेगा। दिस इज कॉल्ड टाइम वैल्यू मनी। The TVM concept states that money today is worth more than the same amount in the future. Example 1. If you receive 100 today and invest it at 10% annual interest rate, it will grow 121 rupees in 2 years. But if you wait to receive 100 after 2 years, you lose out on extra 21 rupees. This show that money today is more valuable. If you have this is the example one we have learned on interest on the investment. Second example is the inflation impact. If you have 100 today and price of rice is 50 per kg, you can buy 2 kg of rice. But if the price of rice rises to 55 per kg after a year, you can only buy about 1.82 kg of rice. This demonstrates how inflation reduces the purchasing power of money over time. Due to inflation, purchasing power will be reduced. Third, example for present value. Suppose your friend promised to give you 100 after 2 years and you want to know what that 100 in the future is worth today. That is called a present value. Using the same 10% interest rate, the present value 100 after 2 years will be. This is the formula we will learn later after this table. Calculate using this formula 100 rupees, 10% interest, 1 plus R bracket power 2 is equal to 82 rupees 64 paise. If your friend giving 100 rupees after 2 years, then today present value of 100 rupees is 82 rupees 64 paise. This means that 100 in the future is worth only 82 rupees 64 paise. This 82 rupees 64 paise is the present value which you are going to get after 2 years. This is called a present value. By not using or investing money today, you lost the potential interest benefit that could have been earned This is called a opportunity cost, which represent the lost chance for money to grow. Conclusion: time value of money concept teach that money today is more valuable because it can be invested to grow or used before inflation reduce its value. Investing or using money today helps avoid future losses. This is the time value of money. If you are having money today, it is more value. You can utilize it, you can invest it, you can earn the interest. This is the time value concept. Sometime one MCQ is coming for this time value concept. Now, present value of rupees. Present value is the current worth of future sum of money given a specific interest rate. It is used to find how much a future payment is worth today. आपका कोई फ्रेंड 10,000 रुपए 1 साल के बाद में देता है, आज उसका क्या वैल्यू रहेगा? दैट इज द कॉल्ड present value of we have learned this is the compound interest formula. Compound interest formula we have learned future value is equal to P principal amount multiply by inside the bracket 1 plus R and bracket power is the N. Now you assume where P is a principal amount investing today. This is the principal amount you are investing today. This P is equal to present value. You write here P is equal to present value. Hence, our formula will become future value is equal to present value 1 plus R की power. Now we want to calculate it present value. Present value calculated, this 1 plus R will come below the future value. Present value is equal to future value divided by 1 plus R inside the bracket power N. This is the present value formula. If you assume future value is rupee 1, you are going to get rupee 1. Then present value formula will be present value 1, 1 plus R ki power N. This is the present value formula. This is a very important formula for valuer, especially for income approach methods. Present PV is the present value of future sum. R is the interest rate per period. N is number of periods. This present value formula discount the future value to the present time using the compound interest formula in reverse. This present value formula is reverse of compound interest. If you remember compound interest formula, automatically you remember present value formula. It is the reverse of the compound interest. It shows the decreased value of money receivable in the future due to interest lost by not investing in today. Now we will learn accumulated value of a fixed annual payment, that is called annuity. If you are depositing in bank 100 rupees, 100 rupees, 100 rupees, 100 rupees, 100 rupees, 5 years. After 5 years, how much you will get the amount? So we can use this formula. Definition. This formula calculates the future value of a series of equal annual payment or investment. This is called a APA, accumulated value of fixed annual payment. You are doing putting in bank 100 rupees for 5 years. After 5 years, how much amount you will get it, you can calculate it. This formula. So, APA formula is equal to bracket, one more bracket, 1 plus R, bracket power N, minus 1 divided by R. Here APA is the accumulated sum of fixed annual payments. R is the interest rate per period. N is number of period. This formula calculates how much a fixed annual payment grow over a time when invested at a certain interest rate. It is used for future value calculation when saving or investing annually. If you are doing saving or investing annually, putting amount in fixed deposit, so you will get accumulated sum of interest by this formula. Now from your salary, PF is deducting. So first you calculate total how much amount is deducted every year of PF, and if you after 30 years how much you will get the total accumulated PF amount, you can calculate and use this formula. You will get it the total PF accumulated amount by this formula. Now next is the sinking fund formula. It is also reverse formula of accumulated value of fixed annual payment. Accumulated sum of fixed annual payment. You this formula you do the reverse. So you will get the sinking fund formula. In detail, we will learn the sinking fund in a income approach. What is the sinking fund? Say if you are construct a house, his house age is 50 years, you will construct a house for 50 lakhs. After expiry of his age, you will come on the ground. So after 50 years, you need a sum of money. Say you need a money of 50 lakhs. So how you will get this money? So sum of amount you are putting in fixed deposit. This amount calculated in such a way that after 50 years, you will get a 50 lakhs for future house. That is called a sinking fund. You are putting some amount, उस अमाउंट को रख के भूल जाइए, वो 50 साल के बाद में काम आएगा, आपको उस अमाउंट पे इंटरेस्ट अर्न होता रहेगा, but that amount is called a sinking fund. So definition: a sinking fund is a way to set aside money annually in order to accumulate a required sum at the end of a specific period. So money you put annually, set aside, पे आपको कितना सम चाहिए वो कैलकुलेट पहले कीजिए, और कितना रेट ऑफ इंटरेस्ट है उसके हिसाब से, और कितना पीरियड है तो उस हिसाब से इस फार्मूले का यूज करने का. It helps in planning for future costs like asset replacement or payment of debt. This sinking fund formula, you remember present value for this accumulated sum formula automatically. This you will get the sinking fund formula. You reverse it, accumulated sum formula. You will get the sinking fund formula. Sinking fund formula R divide by inside the bracket one more bracket 1 plus R bracket power n minus 1 close the bracket. This is a sinking fund formula. This formula calculates the amount that need to be saved each year in order to reach a certain goals. It is the reverse of accumulated payment, accumulated annuity formula. Now we will learn year purchase, YP. What is the YP? Year purchase refer to the capitalized value required to paid once and for all to receive an annual income of ₹1 for a specified period of time and a specified rate of return. That is called a year purchase. आपको हिंदी में एक्सप्लेन इस हिसाब से किया जा सकता है कि आपने एक कैपिटल वैल्यू इन्वेस्ट किया ये मकान खरीदने के लिए। अब आपको उस मकान से 1 रुपये एनुअल इनकम चाहिए for next 30 years, 40 years या 50 years, that is specified period of time or specified rate of interest 5 rupees, 5% या 6% या 7%, जो आपको ये 1 रुपये मिलेगा with specified period of time and specified rate of return on capital value, वो ईयर परचेस कहलाएगा। It is key concept used in property and asset valuation, particularly for income generating property. Income generating property या income approach में ये फार्मूला वेरी इंपॉर्टेंट फार्मूला है। इस फार्मूला से ही आप कैपिटलाइज वैल्यू और ईयर परचेस और नेट इनकम एनुअल इनकम कैलकुलेट कर सकते हैं। दिस फार्मूला इज कैपिटल वैल्यू इक्वल टू नेट इनकम इनटू ईयर परचेस। यदि आपको नेट इनकम हो रही है एक हाउस से 1 रुपया और उसको ईयर परचेस से मल्टीप्लाई कर देंगे तो आपको कैपिटलाइज वैल्यू पता चल जाएगी आपने कितना कैपिटल वैल्यू लगाया है या उसका कितनी एक्चुअल में कीमत है, कितना कैपिटल वैल्यू है। This is net income. This net income is annual income, not a monthly income. Net income is always come as annual income into year purchase. Net income, the annual income generated from the property. Year purchase, the multiplier used to calculate the capital value based on the net income and the rate of return. So type of year purchase, there are 3 type of year purchase. First, year purchase proposal. This is the standard calculation where the investor receive a fixed annual income from an asset. This formula YP is equal to 1 upon R. Here R is the rate of return yield expected by the investor. When perpetual means indefinite period, yes, you can say more than 99 years, 100 years, this formula is used. However, when we are using single purchase formula for more than 60 years, then single year purchase is negligible या equal to 1 upon R. So in future in income approach, if balance period more than 60 years, we will calculate directly this formula. Second is single year purchase. Single year purchase is used when the income from the asset is expected over a fixed period, say up to 60 years, and the calculation accounts for a present value of future income. It discounts the future income back to present worth. So from this formula, you will get it future income back to is present worth. Whatever you are getting the future income equal to what is the present worth. So this YP single rate formula is equal to 1 minus present value divided by R. Present value formula you learned. Present value formula you have learned. What is the present value formula? Is equal to 1 plus R bracket close power n. You calculate the present value, you put directly present value formula here. then 1 minus 1 divided by 1 plus r is equal to n divided by r. So you will get the single purchase, single year purchase. This formula is calculated if balance period up to 60 years, say 30 years, 40 years, 50 years, 60. If balance age of the building is more than 60 years, then we will calculate it using this formula that is called a year purchase proposal formula. Key point of single year purchase. Single year purchase is appropriate when there is a limited term income. Say your income up to 50 years, 60 years, 20 years, 30, such as from a lease. It is useful when valuing asset with a fixed income period and require future income to be discounted to its present value. Third and last formula of year purchase, and this is the last formula also, key value formula. Dual years purchase. Dual year purchase apply when there is both a regular income return and a need for recoupment of asset value, such as through a sinking fund. This is typically required when asset need to be replaced or value recovered over time. If you want a sinking fund amount after 30 years, 40 years, 50 years, and 60 years, then we will use this formula. YP dual rate is equal to 1 divide R plus S. R is the rate of return expected by the investor. S is sinking fund rate, which represent regular contribution made to accumulated a sum of future capital recoupment. For calculating YP in dual rate, first you calculate the sinking fund. With the help of sinking fund formula, we know S is equal to R 1 plus R bracket power n minus 1. You calculate this sinking fund factor and put in this formula, and then you will get the YP dual rate. Dual year purchase is used when investor need to account for both the income return and the sinking fund contribution necessary to recover the asset capital value. It is a typical applied in leasehold property or scenario where the freeholder or lease needs to be accumulate fund to replace or recover the capital value of asset after a fixed term. This all formula today we have learned: simple interest, compound interest, present value, accumulate sum of rupee 1 per year, sinking fund, year purchase. Year purchase. All six formula is very important for value. This formula form the backbone of many valuation calculations, helping in determining the value, help, helping in determining the future value of investment, the present value of assets, or annual contribution required to reach a financial goal. These are essential tools for valuer in a real estate and property. And before going, please do not forget like this video, subscribe this channel, and hit the notification bell so you will get the notification of my new classes. Thank you.